What happens when the successor to one of the greatest investors in history quietly puts $15 million of his own money into the company's stock? Is this a signal that Berkshire Hathaway is deeply undervalued right now? Or is this the beginning of a new era where the legendary Buffett strategy is being tested? Because, something unusual just happened. Berkshire itself started buying back its own shares again. And when insiders start buying, markets usually pay attention. But the real question is this the next big opportunity or a risky moment during a historic leadership transition? No matter where you live in the world, if you want deep documentary-style financial analysis, subscribe now, and let's begin. For decades, Warren Buffett defined the culture of Berkshire Hathaway. His investment decisions shaped the portfolios of millions of investors. But now a transition is happening. The new CEO, Greg Abel, is gradually stepping into leadership. Buffett still remains chairman. But the operational future of Berkshire increasingly depends on Abel, which makes his latest move extremely interesting. Because he didn't just talk about confidence, he invested. Greg Abel recently purchased $15 million worth of Berkshire Hathaway shares. That's roughly equal to his after-tax annual salary. In other words, he just placed a massive personal bet on the company he now leads. In financial markets, insider buying often sends a powerful signal. Executives know the company better than anyone, so when they buy their own stock, investors usually ask one question: what do they see that the market doesn't? At the same time, Berkshire Hathaway itself has restarted share buybacks. The last buyback happened in May 2024. After that, the company paused. But now, the buybacks are back. Why does this matter? Because companies typically buy back shares only when management believes the stock price is below its intrinsic value. So now we have two signals happening at the same time. The company is buying, and the CEO is buying. That combination is rare. But here's where things become interesting. Despite these signals, Berkshire's stock has struggled this year. The stock is currently about 3% down in 2026. After the latest earnings report, it dropped another 5%, which creates a paradox. If insiders believe the stock is undervalued, why is the market pulling back? Is the market missing something? Or is the transition from Buffett to Abel creating uncertainty among investors? Let's imagine the optimistic scenario. If Greg Abel successfully continues Buffett's disciplined capital allocation strategy, and Berkshire's massive cash reserves are deployed into attractive opportunities, the current price weakness could turn out to be a long-term entry point. Historically, Berkshire has benefited from buying undervalued assets during uncertain periods. And if the market regains confidence in Abel's leadership, this could become a powerful new chapter for the company. In that scenario, today's insider buying could look extremely smart. But there's also a risk. The biggest challenge for any legendary company is leadership transition. Buffett's reputation built enormous investor trust. Replacing that kind of legacy is extremely difficult. If investors start questioning Berkshire's long-term strategy, or if future investments underperform, the stock could experience periods of volatility. That's the threat every transition carries. So now the real question becomes, did Greg Abel just send a powerful signal that Berkshire Hathaway is undervalued? Or is this simply a show of confidence during one of the biggest leadership transitions in financial history? Because when insiders buy millions of dollars in stock, it usually means one thing. They believe the future looks better than the present. But in markets, belief and reality don't always move at the same speed. The next few years will reveal the truth.